Hey, it's Mike, and today I want to talk about why you should trade covered calls. And the reason why I'm doing this video is that if you're new to investing stocks, you may have been attracted to all that big gains that you could get trading options. However, when a lot of people start trading options, they start trading calls and puts, and they find out that that's a great way to lose a lot of money very quickly. So I want to introduce you to covered calls because this is a way for you to actually have an advantage because you're not buying stocks, you're not buying calls, you're selling calls. And when you sell calls, your possibility of profit goes much higher and it allows you to generate an income. So let me first just explain what a covered call is in case you're new to the concept. So what is a covered call? So a covered call is basically a strategy where you sell a call, but you use shares that you own as collateral. So as an example, you own 100 shares of a stock. You sell a call option using 100 shares of the stock you own as collateral. So here's an example. Let's say you own 100 shares of GameStop at 12.50. You can sell the 13 strike weekly call at 40 cents. So you collect $40 for selling a covered call at the 13 strike. So that's $13 a share. And that's that's a call option that will expire anywhere from 5 to 9 trading days. So you can make a quick $40. Now, that doesn't sound like a lot of money, but just be aware this is a weekly option, and you could do this sometimes anywhere between 4 and 7 times a month. And this is how you build up your portfolio. It's not one of these big YOLO Wall Street bets things where you hear people turn $1,000 into $100,000. That's like basing your financial planning on someone who got a big hit on the lottery because those people beat the odds. With covered calls, the odds are on your side. So you're just collecting a lot of money. I mean, you're collecting a little bit of money over time. It equals a lot of money. So let me explain a little more why you should use covered calls. First, it's an income generating strategy, which is it's a strategy when you, especially if you do covered calls on weekly options, you're paying yourself every week and sometimes multiple times a week if you play a certain way. Also, it allows you to make money when the stock really doesn't move. So let's say you own GameStop at 12.50 and the stock only moves up to 12.55 or 12.45, you still collect the entire profit on the covered call that you sold. Also, bear in mind that 80% of options expire worthless. That's why it's always better to be a seller of options than a buyer. Options are kind of like an insurance policy, especially when it comes to puts. So you become almost like an insurance company. And there was a great video out there, and I can't remember the guy who did it, but he's a big options trader. But he showed people pictures of skylines around the city, and he said, you notice that the biggest buildings in San Francisco, in New York, London, a lot of the big business buildings, they're all have the names of life insurance companies on them is because life insurance companies make a lot of money selling insurance. And what you're doing when you sell options is you're essentially selling insurance. Yes, occasionally an insurance company does have to pay out when there's a big disaster. And when you sell options, you do have to pay out when there's a big disaster. But as you'll see here, people tend to overestimate the movements in the market. So people will think if you own GameStop, you'll think, well, it's moved up 10% last week, it'll move up another 10% this week, so people will buy calls. When in reality, stocks do not tend to move up and down as violently as people think. Now, I think because of the recent crash we had in March, people think that's something that may happen a lot, and the big rise we've had in the markets. The market doesn't tend to move like that all the time. So because of that, it's better to be a seller of options than a buyer of options. So now that we know the reasons why you should trade covered calls, let's look at the type of stocks and ETFs that you should use to do a covered call. And this is the strategy I use. And this is a strategy that has been working for me. So first thing you want to do is find a stock or ETF that's sitting above the 50-day moving average. And that's because the 50-day moving average is a strong line of support for that stock or ETF. And you also want to make sure that the 50-day moving average is above the 200-day moving average. So this is a stock or ETF that's been performing really well. It's close to its 52-week highs, and therefore it has upward momentum. And therefore, these are good stocks or ETFs to do a covered call on. But what I also like to do, I like to find these stocks or ETFs that are moving really, really well above the 50-day moving average, but they've had a bit of a sell-off. And because they have a bit of a sell-off, they're much more likely to move higher in the next week or two. And it's basically the buy the dip strategy. You have a stock that's been really hot, dips a little bit, you essentially buy the dip, you do a covered call, and it's more likely to move upward than it is to continue moving downward as long as that stock or ETF is above the 50-day moving average. And what I like to do is choose a weekly covered call, not a monthly call, a weekly covered call. So this is a call that will expire anywhere from 5 to 9 trading days at around the Delta 40. So it may not be right at the money, but a little bit out of the money. So it gives you a little room there. And also, instead of taking the entire profit, I like to take the cover call at a 50% profit because it allows me to open up a trade for next week's positions. And sometimes you can get more than 4 trades a month. Sometimes you could get 6 or 7 trades a month. And this is just a way that you continue to make money. You just generate money week after week. And it doesn't seem like a lot of money at first because it's like, oh, I'm only making 20, 25 bucks this week on 100 shares. But trust me, it does add up. And with that little bit of money that you're making each week, you can buy more shares. And you'll be surprised how fast over the period of a couple of years you begin to make some serious money. So I hope you become more interested in covered calls if you have just been looking at straight buying calls and buying puts. Covered calls is a safer and smarter way to generate income when it comes to options trading. So I hope you enjoyed this video. If you did, please be sure to leave a like on this video and go ahead, subscribe, and turn on notifications. I do lots of breaking news on stocks and educational information on stocks and options trading. Okay, thanks. Bye.